Ladies and gentlemen, thank you for taking the time to be here with us today. Welcome to A Smarter Way to Protect through Life Insurance Premium Financing. My name is Andrew Marin, and it's my pleasure to take you through this journey on premium financing. A little bit about us. We are a premium financing third-party administrator for major insurance carriers. We assist banking and lending institutions in structuring and design of insurance premium financing. Our specialty is with life premium financing, not only for estate planning, but also for business succession planning and the many uses that go along with that. We assist in case structure, packaging, approvals, and point of sale from the beginning through the annual renewals. Our on-staff accountant and attorney can assist with paperwork, with trust drafting, with verification of documents, etc., and how to work with us. You make the introduction to the client, attend meetings, manage that relationship, and you can think of us as your back office to assist with all things premium financing on your behalf. And the topics that we're going to cover in this three-part series are insurance product options, crediting rate choices, determining borrowing rates, loan exit strategies, maximizing your financial practice with premium financing, and then really demystifying what premium financing means and where it is in today's market and looking to the future. Ways premium financing can help clients are through employer-sponsored pension plans, for recruiting and retention, for business owner exit strategies, funding buy-sell agreements, and wealth transfer and estate planning are just a few topics to keep in your mind on the front end as we go through this journey together. Now, this is a bird's eye view, a carrot, if you will, on how this structure works top to bottom, and we'll get much more in detail on each one of these as we go along. But in this example, we have a 40-year-old client deciding to finance premiums of a $5 million life insurance policy to create a tax-free income and also have that death benefit protection long term. So column, if you look to the section 2 here on the left, utilizing, in this instance, a $144,000 piece of collateral. The client takes out a $1.3 million bank loan. The loan is divided into 7 annual payments of $195,000 and put into an investment-grade life insurance policy. The client services only the interest portion of the loan, while the cash value in the life insurance policy grows tax-deferred. In the 14th and 15th year of the plan, the loan principal is paid back from cash value of the life insurance policy itself. And then column or section 6 here on the top right, at age 65, the client enjoys a lifetime income from the life insurance policy in the form of policy loans. The income increases each year to allow for inflation. Now, to look at this just very briefly, in the next seminar we are going to go through one of these in detail, but this is what one of our strategy sheets look like, where we are able to incorporate all of the elements of the insurance with the elements of the financing. So we're going to move on from here. Now, permanent life insurance. People usually realize the need for insurance as part of their overall estate or business plan, and they also usually have an objection paying for it using current assets, and that's where premium financing may be able to help. Permanent life insurance can provide a death benefit and also cash accumulation for company group plans, employee recruitment and retention, legacy protection, estate liquidity, wealth transfer, living benefits, charitable planning, business succession planning, retirement income, funding buy-sell agreements, and the list really goes on from there. And what is premium financing? Well, premium financing is an innovative approach to wealth transfer and retirement planning. No longer is there a need to liquidate assets to pay life insurance premiums, and it preserves cash flow for other uses. And our goal here is to simplify this financial instrument into an easy to understand and easy to apply strategy. Why finance policy premiums? Well, for individuals considering life insurance policies with large annual premiums, life insurance premium financing may be an attractive alternative for funding required policy premiums. Benefits of premium financing include helping to preserve current standard of living by freeing up cash flow currently used for premium payments. It avoids having to liquidate investments and avoid the possible related capital gains tax consequences in order to raise cash for premiums. May fund a tax-free benefit not included in your client's estate, allowing proceeds to avoid estate taxation. Enables leverage of your wealth to provide future benefits to your heirs, favored causes, or institutions. And the loan may be set up to accrue loan interest payments, reducing demands on future cash flow. Now, conversely, considerations of a premium financing strategy. The other side of the coin is there's an interest rate risk assumed by the policy owner. There may be additional need for collateral in the future. Gifts may be needed to provide capital to the trust to fund higher interest rate premiums, higher interest payments or premium payments. And annual monitoring should be done to ensure the transaction is going according to plan. And that's what we are here to help with. And purchases in general. From a very high level, there are two ways to purchase anything, cash or credit. And we use a real estate example to bring this into everyday discussion. And Beverly Hills example is an affluent neighborhood in Southern California. And how do we buy expensive real estate? Well, you can pay cash out of pocket or you can finance or mortgage that purchase. And in the Beverly Hills example, we have two options illustrated here. We have the first option of deploying $2 million into this home, and now your money is sitting there. You have a fully paid off home, but that money is not going to work for you. The alternative to that would be financing at a 3% interest rate of $60,000 each and every year. Now let's assume that in this first year, instead of deploying $2 million directly into a home, we were to finance or get a mortgage. That retained capital or preserved capital of $1.94 million, we still have access to. Now let's assume that we put that $1.94 million into an account at 5% growth. Well, after that first year, we're already over $2 million. And after 10 years of investing that retained or preserved capital into an account with a 5% growth, our total savings after 10 years are over $500,000. And that's a pretty compelling story. And can we approach life insurance in a similar way? And the answer is yes. And did you know that more than 80% of all permanent life insurance policies never pay a claim? That number is over 90% for term policies. The three main reasons are term policies lapse, cash value policies are surrendered, policies are not properly funded. And what does that mean? Well, that translates to an 80+% discount on life insurance. Again, why do we buy life insurance? Well, one, for death benefit protection, two, for cash accumulation, among other things. And how can we win? Well, we can properly fund a life insurance policy from the beginning. And again, not to beat a dead horse, but there are two ways to accomplish this. Again, pay cash or borrow the funds. The answer that we're looking to is leverage. It's leveraging a lender's capital, retaining use of your own capital, your client's capital, for investment opportunities. Now, the premium finance design. When arranged properly, life insurance premium financing can be a very valuable component to your state or business plan. And this is just a very brief introduction of the process. The client establishes an ILIT, or an irrevocable life insurance trust, as it's known, after making determination if financing can be obtained on a favorable basis. The trustee of the ILIT applies for insurance on the client or spouse. The client pledges collateral. The lender advances those funds to the trust as needed to pay for the annual premiums and possibly to cover interest on the loan. The trustee pledges the policy as primary collateral for the loan. The trustee repays principal and interest, if applicable, to lender from policy proceeds at the time of death of the insured or before from cash growth in the policy. and the net proceeds are distributed per the terms of the trust. Now, this is a diagram illustrating just that. We have the grantor, or the insured, whomever that individual is, the grantor of the loan, establishes the ILET. To my left here, we have the irrevocable trust holding the life insurance policy, and on the right, we have the lender, which funds the premiums. So we have the grantor, again, establishing the ILET, gifts interest payments to this ILET, or this irrevocable trust. The grantor provides additional collateral for the first years while there is a shortfall between the outstanding loan and the cash in the policy, which we'll see shortly. And the lender funds the annual premiums. Now, the lender will receive principal plus interest from the death benefit of the policy if the insured passes away while the loan is still in force, or from policy cash value once there's a determination that there's enough cash in the policy to sustain repaying the loan. And then the beneficiaries receive the net proceeds of the loan itself. Now, establishing an ILET is a sophisticated way to protect an estate and generate cash to pay death-related taxes. Cash is needed at the death of the insured to pay taxes, settle debts. Properly structured life insurance proceeds can be tax-free, maximizing clients' after-tax return. Life insurance provides a competitive ratio of cost to benefit, preserving clients' estate planning options. And an ILET funded with life insurance can mitigate the need for complex, time-consuming, and costly asset sales by replacing wealth lost through estate taxes and fees. Now, who qualifies? Who are we looking for? Well, we say the healthy, the wealthy, and the wise. Really, age 18 to 89, a net worth of $5 million or greater, and that goes for both individuals and businesses. And note that higher income earners or younger clients may qualify at a lower net worth. Types of clients are business owners, doctors, hospital groups, healthcare organizations, attorneys, corporations, professional athletes, entertainers, really anybody that fits that criteria above. And our insurance options are whole life or indexed universal life, survivorship policies, private placement life insurance. And our borrowing options are typically 1 year or 30-day LIBOR plus a fixed bank spread with the option to purchase a cap or a collar on that rate. We have the option of true bank fixed rates, as well as more sophisticated strategies such as swap rates, and our terms are typically between 5 and 10 years. Now, the S&P in the last 10 years, on the left, we're looking at investing directly in the markets, and on the right, we're looking at investing into an indexed account or an insurance vehicle itself. Now, if you notice, we're going to assume a $100,000 initial investment, and you see the volatility here of investing directly in the markets. You have some very attractive years and you have some not so attractive years. As opposed to investing into an insurance policy with in this assumption, a 2% floor and a cap of 12%, you see that we're really able to mitigate in those lower years the rate of return and make sure that in the years where there are great returns, we're still getting an attractive return. In this instance, again, a cap of 12. And when the market really does poorly, we are still at an attractive floor of, in this, again, analysis of 2%. And over this 10-year period, the average rate of return is 9.49% in the equity markets, as opposed to a rate of return of 8.65. However, that $100,000 initial investment is $209,000 as opposed to $227,000 in the insurance vehicle itself. And this is, again, just an analysis showing the difference between those two. And beyond death benefit, this is investment-grade life insurance with guaranteed cash value and death benefit, attractive growth potential with minimal downside risk, and living benefits, including long-term care, critical, and chronic illness. And again, case-specific determination. We have the option of a floating, collared, or capped rate, true bank fixed rates, sophisticated hedging strategies, and we're able to achieve rates as low as 1.75%. Now, in determining borrowing rates, this is our analysis of 1-year LIBOR average and then stress testing that within the policy itself. So if we look to the left first, we're looking at any year from 2005 to 2015. This was the average 1-year LIBOR rate for that year. And if you look at the 10-year average from 2005 to 2015, the average LIBOR rate was 2.39%. Now, if we were to take that average and add a 200 basis point or 2% spread, assuming that's the lender spread, then we would be borrowing at an average of 4.39%. Now, if we were to take that figure, let's say that we're achieving our borrowing rate based on last year's 1-year LIBOR rate, and we're assuming a 2% bank spread, that first year of an annual premium of $2 million would be 2.7% borrowing, and then we're going to stress test this policy at 25 basis points or 0.25% annually, and that's what the annual interest would reflect, that the client would be either servicing annually or deferring into the policy or a combination therein. And it's important to look at how everyone wins. And there are really three perspectives to keep in consideration. The client wins because there's no longer a need to liquidate assets or deploy active capital to service insurance premiums. The insurance company wins because they now have an overfunded insurance policy right from the get-go. The lender wins because it's fully cash secured credit from three sources. One, the cash surrender value. Second would be the death benefit. And lastly, the outside collateral pledged in the early years of the policy. And deal structure. These are important terms just to keep in mind for this premium finance transaction. The borrower is a client with an estate planning need, minimum net worth of $5 million, again, can also be a business or for a corporate entity. The borrowing entity of the loan is an irrevocable life insurance trust or other estate planning vehicle. The loan amount, we're able to borrow up to 40% of the client's net worth to go to those premiums. Maturity, up to a 10-year commitment, renewal at the bank's option. The guarantor is able to achieve recourse or non-recourse loans. The interest rate, again, is LIBOR or prime. Interest rate protection strategies can be integrated with premium finance collateral pool and loan documentation, among other things. Repayment, principal payable at maturity and interest payable at the option of the borrower or funded by the bank. Collateral can be achieved in several ways. The main are illustrated here from the cash surrender value of the policy and assignment of that policy, from marketable securities, non-qualified accounts, cash or cash equivalents, as simple as a letter of credit from a bank, or a business line of credit that is securing a standby letter of credit may work as well. And client disclosure required, stating risks and disclaimers, again, regarding this premium finance structure. And again, there are three options to purchase. We have borrow, lend, or gift. In borrowing or bank financing, the client would write a check for premiums. Gift tax would be owed based upon the amount applied towards life insurance. There's no interest rate risk. It's predictable. And if structured properly, the heirs receive 100% of the death benefit. To lend or a grantor loan, loans are made to the trust to cover premiums, plus annual interest, the loan interest based upon AFR rates, interest rate risk, unpredictable cash flow, and then gifting. You're subject to gift taxes. Borrowing funds from the lender, interest may be paid or accrued, typically paid to annual gift tax exclusion limits. Fixed or floating borrowing options, the client retains capital for investment opportunities, and there's no longer a need to liquidate assets for those insurance premiums. Collateral options. Acceptable forms of collateral are cash or cash equivalents, money market accounts, letter of credit, again, a business line of credit securing that letter of credit, cash surrender value of existing insurance policies, non-qualified accounts, and in some instances, we can look at real estate as a form of collateral. Unacceptable forms would be qualified accounts or qualified annuities. And that wraps up the part one of this three-part seminar. I'd like to thank you for your attention to this,